path A, this column on the left hand side, what we're seeing is that first year, $234,000 is able to be invested because he had to pay a whole lot of tax first, right? Year 3, that has now grown. He's continued to put money into it. Year 5, he's amassed about $1.3 million after tax, no contributions. And out there at the end of 10 years, he's amassed about $1.8 million. Okay. So not a bad day, even from a savings perspective. But what if we were able to put money into this cash balance plan first? We're able to put in the large amount of capital there. Well, 400,000 goes straight in, compounding, let's say 4%. End of year, it's about 416,000. Over 3 years, that's 1.3 million. 5 years, that's when he's going to retire, 2.2. And then we convert it to the IRA, as we discussed. And out there, year 10, now he's got $3.3 million. So the biggest, I'll say, pushback I've gotten from other advisors about these plans is, hey, taxes are going up. They're not going down. You're setting your client up for failure because taxation is going to be so much higher in the future. I agree with that over a long period of time. I think the likelihood of the highest marginal tax rate right now doubling in a 5-year period is extremely unlikely. Therefore, if his income is $1 million a year today, but in 5 years he's going to retire and that income stream turns off, he is almost definitely going to be in a smaller tax bracket. And so now we have a larger amount of capital, that 3.3 million in this assumption example, right? That we can pull from for retirement income at a lower bracket for a long period of time. And he can even be doing some Roth conversions along the way as well if he wants to, once it's in that IRA.
I think that's well said. Is it's not like we're banking on 40 years from now. There's guardrails, and it really comes down to situation, and hence why this would not make sense if someone didn't have a tax problem. But if someone feels like that tax pain, um, it could work perfectly where they're actually getting a deduction in a higher tax bracket. And even if the tax bracket stays the same, it's technically a wash. But if it goes down, which in a lot of cases it could with right planning, you're also going to be making out as well as having the opportunity of an asset growing. So
Yeah.
I think that's well said, and I appreciate you mentioning that, because on this channel we've had people that talked about future taxes, and I think it's a really powerful thing to not check your brain at the door, because there's a lot of tax strategy that's like, hey, we're just going to defer for the next 40 years. And it's something that you should at least be aware of the consequences of what that could turn
Yeah.
into.
Absolutely. And for this particular situation, and we just say the worst case scenario is that even though he drops down a tax bracket, that new tax bracket's 45% still for somehow. Even in that scenario, and we wipe out 45% of what was accumulated, you still have effectively a net wash. But what's the backup? Inside this cash balance plan, we're actually also purchasing a whole life insurance contract. And so every year out of that $400,000, we're able to put in $100,000 into a tax deferred vehicle of life insurance. Now, we'll be talking in a minute about the benefits of how that can come out in the future and what that looks like. But in just this snapshot, in the worst case scenario, it's a wash, but now he's got a $4.4 million pre-tax family legacy protection that he's built because he also has insurance inside of that plan. So understanding the worst case, it's really not that bad in the worst case in this example, but the better option is to optimize the retirement withdrawal. And so in the future, he's not going to be earning $1 million a year because his business is going to be wound down. So now he's in a lower tax bracket. He's going to be wanting about $350,000 a year, which we would be compounding over time with a cost of living adjustment to make sure he keeps up with inflation. And from that point, his taxation in his state is only around 20 to 21%. So that massive bracket arbitrage means that the net cash in his pocket is over $2.6 million because of the savings that we had in the cash balance plan, and then now how much money he's saving as well, being in a lower tax bracket. So by pocketing an extra $820,000 in net wealth compared to the standard taxable brokerage account we saw above, this is a $800,000 tax arbitrage victory, effectively using the tax code to supercharge his retirement. And so the whole concept of the cash balance plan, at least from our perspective and how we choose to work with our clients, is this is a strategy we want to do for a short period of time. And for David's situation, it's 5 years. After 5 years, plan rolls into your IRA. We also purchase out the life insurance policy. We'll touch on that in the moment. And now you have an asset that can fund your retirement at a lower tax bracket, plus a tax deferred vehicle that was purchased with pre tax dollars. Said another way, you bought an insurance policy with dollars that were never taxed. And now those dollars will never be taxed again once they're out of the plan, which we'll touch on.